The Indian rupee is at record lows. You can see it here. At the time of filming this video, it's at 83.4 to the dollar. The higher this number is, the weaker the currency is. Meanwhile, India's foreign exchange reserves have hit a record high of over $640 billion. In fact, India ranks among the top countries in the world on foreign exchange reserves. To just put the number in perspective, if Pakistan was hypothetically for sale, we could buy the whole economy of Pakistan and still have over $250 billion left in our reserves. So, should you be concerned about the record weak exchange rate, or should you be relieved of the sky high forex reserves? How are the two even related? And what should you be watching out for next? Hello and welcome to The Bond Economist, your one-stop destination for professional advice on the economy. My name is Auradeep Nandi, and today we talk forex reserves and currency. What on earth is going on with India? As always, if you want this kind of content curated for you, please hit the subscribe button, and if you'd like to support me, feel free to tap that super thanks button below. First things first, where are these forex reserves coming from? Well, at one level, it's really simple. Dollars come into any country from broadly two avenues. First is what is known as the current account. That is what we export minus what we import and what we get in terms of remittances from our relatives abroad. On a net basis, our current account is generally in deficit mode. That is, we import more than what we export and what NRIs across the world send to their families in India. So by that logic, dollars should just be escaping out of the country and the rupee should just be getting weaker and weaker. Which brings us to the second avenue for dollars, the capital account. And within it, the major component, foreign investment. This could either be investment into Indian stock or bond markets, also known as FPI or foreign portfolio investment, or it could be investment to set up or buy businesses in India, which is known as FDI, foreign direct investment. Now, because India is an emerging market with exciting growth opportunities and relatively higher interest rates, this is where we get the dollars to plug the hole in the current account. So if you add the two up, the current account and the capital account, you get the net amount of dollars entering or exiting our country, also known as balance of payments. Now, when dollars come into the country, two things can happen. First, everyone buying our goods or investing in our country would need rupees. So they will convert their dollars to rupees. So naturally, there's going to be a shortage of rupees in the market. As with anything in economics, shortage of something means that the price will shoot up. So in this case, the rupee appreciates. But rupee appreciating also means that Indian goods become more expensive to foreigners. Suppose if the dollar rupee exchange rate were to appreciate from 83 to 73, then earlier $1 could get you 83 rupees worth of Indian exports. Now it can only get you 73 rupees worth of it. So that puts our exporters at a disadvantage. So then the RBI can step in and say, hey, we don't want the rupee to appreciate. Instead, let me buy those dollars that are coming in. So the RBI buys the dollars flowing in, and it does so by exchanging rupees. So the supply of rupees in a market that had earlier gone down now starts to go up. The value of rupee consequently goes down. That is, it no longer strengthens. Similarly, when there's an outflow of dollars from the country, it could be because there are higher interest rates globally, or there is a crisis brewing in India. Foreigners dump the rupee and buy dollars. So there's excess rupee in the market and the value of rupee plummets. Then the RBI can say, wait, I don't want the rupee to weaken so much. Let me sell my forex reserves. That is, let me sell all these dollars that I have accumulated in exchange of rupees. In theory, this should reduce the supply of rupees and hence plug the depreciation of the currency, which kind of happened in 2022. You can see that forex reserves slumped from record highs, similar to levels currently, in fact, at around $640 billion to around $530 billion. So a loss of around $70 billion. This happened after Russia invaded Ukraine. The dollar was stronger, investors were spooked, there were foreign investment outflows from India, and the rupee got under depreciating pressure. The dollar strength not only led to the value of our reserves going down, but the RBI also sold off foreign exchange to try to control the rupee depreciation. In fact, Governor Das famously said at that point, you buy an umbrella to use it when it rains. So his point was that, look, we accumulated reserves for a rainy day, and here's the rainy day, so we are using it. Why are you panicking that reserves are falling? However, controlling the exchange rate is easier said than done. If the exchange rate was a kid, RBI risks coming out as a controlling parent. But whenever you tell this to the RBI, it keeps saying that, hey, I'm not a controlling parent. I'm not fixated with any particular level of exchange rate. All I want to do is to ensure that the kid doesn't throw tantrums. That is, the exchange rate doesn't jump up or down too much. So basically, the RBI is saying that, look, officially, we don't care if the rupee is appreciating or depreciating. We just want to minimize its volatility. In real life, though, the line between controlling volatility and fixing the exchange rate at a particular level ends up being quite thin. In fact, if you look at the chart of dollar versus rupee, you'll find that until recently, the exchange rate has traded in a tight band of around 82 to 83 since more than a year. In comparison, look at the dollar index, that is the value of dollar against a basket of currencies. It has depreciated, and in fact, it's been volatile. It's gone down, it's gone up, it's gone down, gone up. The rupee, on the other hand, absolutely calm. Interestingly, this year, not only has the dollar been weaker, but we've also had pretty strong investment inflows. Total foreign investments, that's FPI and FDI together, has been around $56 billion in FY24 so far, up from $33 billion in the year before. But instead of appreciating, the rupee has maintained yogic levels of calm. And why is this the case? Well, always know that whenever the exchange rate is very calm, there is a central bank behind it, furiously at work. Data so far suggests that on the spot market, the RBI has bought over $170 billion. So purchasing dollars prevents the currency from appreciating. It also sold over $150 billion. So whenever the currency was depreciating, it would do this to put a stop to that. And these are pretty large levels of interventions, historically speaking. Basically, the RBI has been, well, for the lack of a better term, managing the exchange rate. Now, when the IMF flagged this, the RBI went ballistic. They said, how dare you? We don't manage the exchange rate. We just stop it from going too volatile. And there's a reason why the RBI doesn't want this currency manipulator tag stamped on its forehead. Well, first, this attracts the attention of our trading partners. Because as I had mentioned earlier, a weaker exchange rate benefits our exporters. So there's always that temptation to keep the currency artificially weak as a subsidy to exporters. And obviously this is generally frowned upon by our trading partners. The US, in fact, regularly publishes a list of currency manipulators in an effort to take action against such countries. And in fact, India has in the past found itself on the watch list for this. The second problem in intervening too much is actually domestic. Aggressive forex intervention complicates monetary policy. Because what ultimately happens when RBI buys dollars to prevent the rupee from appreciating? Well, it has to sell rupees. Rupees that now flood the domestic money market, increasing market liquidity. After all, when money is available cheaply to banks and financial institutions, the interest rates at which they lend and borrow with each other start to inch lower. Now, this will be a problem if inflation is elevated and the RBI is keeping its policy interest rate or repo rate high to control it, as is in fact the case currently. So it doesn't want to do that on one hand, and then on the other hand, trigger a flood of rupees to enter the market in an effort to build forex reserves. Which means that the RBI then has to find a way to soak up that excess money from the system that it has released to control the exchange rate. For instance, by selling government bonds. So, people keep saying that it's great, India has huge forex reserves. True, but mind you, there are trade-offs involved. Chief among them being that it turns the country's central bank into a control freak. That said, in the current economic environment, bulking up on reserves might end up serving the RBI quite well. So one of the factors leading to a bump up in forex reserves this time around was the maturity of the $5 billion worth dollar rupee swap. So back in March 2022, the RBI had undertaken a dollar rupee sell buy swap. It sold dollars to banks with the agreement to buy back those dollars in the future at a particular rate. So back in 2022, inflation was much higher. The RBI wanted to tighten liquidity. So selling dollars and in the process soaking up rupees from the system worked well for the RBI. Now, after 2 years, the RBI could have rolled this over, but it instead said, hey, actually, let this mature. Let me fulfill my contract. I will buy back those dollars from banks. Why? Well, because inflation now isn't that high. So RBI is not as paranoid about keeping market interest rates sky high. It has, in fact, been slowly easing liquidity conditions in the past few months. So it happily buys the dollars and in the process injects money or rupees into the system, and also as a bonus is getting to add to its pile of foreign exchange reserves. So if more foreign inflows come in at this point, the RBI actually wouldn't mind absorbing them, adding to its reserves and stopping the rupee from appreciating. In fact, in a recent op-ed, the RBI governor in fact said that it is a conscious decision of the RBI to build forex reserves. But that begs the question, how much of forex reserves are enough? Well, like most things in economics, there's no correct answer for this. In theory, higher forex reserves work as a sort of insurance for the country. If the rupee sharply depreciates tomorrow, then the RBI can sell the dollars and help shore up the currency. But economists aren't entirely sure how much is enough. There are many such arithmetic measures. One popular way is to, for instance, calculate the number of months of imports your reserves can fund, which kind of means that suppose if we are in an economic apocalypse where the country is on the brink of bankruptcy, as has been the case with countries like Pakistan or Sri Lanka, then hypothetically, how many months of imports can we fund using our reserves? And the answer for now is roughly 11 months. And that's not bad at all. Back in 2013, when we were in a really bad shape, this number had fallen to around 7 months. Peak levels would be probably around 13 months and above. So we are very much at comfortable levels. But some argue if there's indeed a point to keeping so much reserves to defend the currency. Yes, it inspires confidence. And look, that is very important in the economy. But when push comes to shove, and when the currency is in a tailspin, how effective are reserves? I mean, suppose for whatever reason, the rupee starts to sharply depreciate tomorrow. You are an investor. You see the RBI having a large war chest of dollars, and you know that the RBI will burn through these dollars to try to stop the rupee from going down. What will you do? Well, of course, you'll try to get ahead of the RBI. So whenever any central bank tries to defend a particular level of exchange rate, the market will inevitably end up challenging it. And eventually the central bank will have to sell more and more foreign exchange to defend that level of currency. And ultimately at one point it has to give up and say, okay, I can't waste any more of my dollars trying to defend this level of currency. You win, market, let it fall as much as you desire. So while in peacetime, reserves do make you go, all is well, during actual war, well, there's no guarantee. Sometimes they work, sometimes they don't. And you know what? Sometimes excess intervention in the currency markets, even if it is just to control volatility, can backfire. So recently, the currency started getting quite volatile. The Chinese yuan depreciated sharply, which put pressure on the rupee, and this time, for reasons best known to the RBI, it didn't step up to control the volatility. So after remaining remarkably calm for over a year, the dollar rupee rate rapidly weakened from 83 or below to 83.4. That's kind of sharp depreciation over a very small period. And people got their fingers burnt. Why? Well, when you know that the currency is going to go up and down, companies will look to hedge because they don't want to lose money if the exchange rate goes in the other direction. So hedging is essentially like an insurance policy against adverse movements in the currency. You fix a particular level that you're comfortable with. But what if they see that for month after month the RBI is keeping the exchange rate virtually constant? Then they would be like, wait a minute, why should we spend money on hedging when the RBI is effectively doing that on our behalf by having a tight grip on the exchange rate? So then they go into a state of lull. But this means that when the RBI decides that it won't intervene, that there are forces at play that are too much for it to try intervening, well, then a mini financial earthquake happens for these companies who haven't hedged their foreign exchange exposures. And whether the RBI will play on the front foot or not becomes even more crucial in the coming months. India's inclusion in the JP Morgan Emerging Market Global Bond Index means that some $25 billion or so are likely to flow into the country. Probably more if one also considers the inclusion of the Bloomberg Emerging Market Index. These are like conceptually like your Nifty or Sensex indices. It's a collection of bonds of emerging markets globally. And India has recently been invited into this club from FY25 onwards. So now a lot of global funds that track these indices will have to most likely adjust their portfolios to buy Indian government bonds. So all of this foreign money will be flowing into India. Good global growth so far has also helped India's exports, and in fact India is scaling record high levels of services trade surplus. Not just from IT, but also with India emerging as an important exporter of professional and business services. So all these dollars will be coming in, and if the market is left to its own devices, this should lead to an appreciating rupee. But the question is, will the RBI allow it? Or would it rather take this opportunity to further add to its reserves? For more such insights, like, share and subscribe to The Bond Economist.